mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we will help you learn to invest in 20 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. How are you?
Mate, very well. Feeling a bit under the weather. It's been a big week, but what can you do? Got to push on.
Yeah, that's it.
For those that did tune into last week's episode, we said that I was going to surprise Ren with a quote that I had come across in a podcast, and because of time, we decided to save it for this episode. So that's what we're going to focus on today. So Ren, if you don't have anything to add, we may as well jump straight into it.
No, let's do it. I'm very excited. I've been waiting all week to do this.
Rightio. Well, so let's give it some context. The quote comes from a podcast called The Investors Podcast. We Study Billionaires. In my opinion, a very good podcast for all investors. It doesn't necessarily speak to all beginners, but by all means go and give it a crack. They speak to a lot of very good and professional experts in the industry, and you can absolutely get a lot out of it. I know you also enjoy it, Ren.
Yeah. Even though they're probably technically our competition, we're all about spreading the love and growing the pie for all investing podcasts out there.
Absolutely. We did actually ask to interview them, and they said no. So
so we just stole a clip from their show instead. Come at us, Investors Podcast.
Come and get us, exactly. So we're plagiarizing their show. Yeah. So look, one of the people that I wouldn't say regularly, but one of their good friends is a guy by the name of Jesse Felder, and he does often appear on their show. And he's one of the investors that I, like following more so than others. I just feel like I am more on board with his thesis than a lot of others. And he runs a very good online blog called the Felder Report that is definitely worth checking out. So head to his website, and obviously we're giving him a plug as well. But just to give a bit of...
And he also has a podcast as well.
He does. He's got a couple, doesn't he?
No, I think his one is Super Investors and the Art of Worldly Wisdom. Is that
That sounds familiar, yeah.
Yeah, I'm pretty sure that's him.
So
if not, we'll just give that podcast a plug as well.
Let's just plug heaps of podcasts on this episode.
We could do an episode on that, the investing podcast we listen to. It may be shooting ourselves in the foot, but if it helps our listeners, that's probably a good thing.
If we see a mass exodus after that episode, we know we've really hurt ourselves. Yeah. Anyway, so I think so let's give some context to Jesse. Jesse is a very intelligent man, and he's been managing money for over 20 years now. Began his professional career at Bear Stearns & Co., and then later went on to co-found a multi-billion-dollar hedge fund that was headquartered in California. As a result of that, he's obviously been able to retire happy, and today he just works with a select group of clients privately through his Felder & Company, and he dedicates time to this blog. I think he releases a couple of pieces or articles each week, and it's just great to follow his insight on the market. Now, that's what leads into this quote, Ren. So you have a thesis. Well, how about we listen to the quote first, and then and then we can chat. So I was listening to this. This was him being interviewed by the Investors Podcast, Stig and Preston, and among other things, they asked him about his theory on the buy and hold cult. So let's take it away.
I'm really happy you bring this up, Jesse, because it's really a nice segue to the next question we're going to ask. And this is really my favorite question here for this interview, because as an avid reader of your blog, I love how you coin new financial terms. You have this thing that you call the buy and hold cult. So could you please tell us what do you mean by that? And what is it that the buy and hold cult doesn't want retail investors like us to know?
Right. That was a choice of words that I mean. I really think that we are in a speculative mania currently, and a bubble. And one of the ways that George Soros defines a bubble is there's some narrative that supports the bubble that is patently false. And so in 1929 and 2000, it was very similar. We're entering a new era where growth is going to be above the historical trends, and valuations don't matter, and all these brick and mortar companies are dead, and eyeballs are all that matter, and it's this idea of a new era was going to save us and going to make anybody who committed any capital at any price a millionaire. That narrative was proven, drastically wrong in the years to follow. I think today the narrative that is clearly wrong is that people say I can invest passively because so long as I have a long enough time frame, I will always be made whole. I don't care about what the next bear market holds for me. I don't even care if it's a 50% drawdown. I'll make my money back. And that's what the markets have taught them over the last 20 years. But markets have a habit of teaching you something and then, just in time to teach you the opposite lesson. And so I fear that today, there's the narrative that is going to be proven false is that people believe so long as I can hold on for 20 years, I'll be made whole. And, if you were to say that to Japanese investors, they would laugh you out of the room. Today, the Nikkei, peaked in 1990, and it's still below its peak price from 1990. I don't see why that's not possible here. And in fact, when you look at the valuation, you look at the Buffett yardstick, right? You look at market cap to GDP. Today, our market is more expensive on this Buffett yardstick than the Japanese market was in 1990. So to me, that's a real possibility. And I talk about this buy and hold cult because I think there is this mindset of people who think, as long as I can hold on for 10 or 20 years, I don't need to worry.
Alrighty, Ren. So did you listen to all of that the whole way through?
Yeah, I did.
You didn't stop it at any point in time?
No, I listened to it all.
Okay, so I guess the reason I played it to you was because something that we've discussed at the live shows that we've been doing and we've been discussing on our podcast over the last couple of months or so is this notion of, over a 20-year period, the markets have never been down, and this sort of buy and hold strategy is definitely one that you can put in place. And so when I heard Jesse come out so confidently and say that he thinks this approach may be entirely incorrect, I thought I would give it to you and see what you have to say. What are your initial thoughts?
So the first thing is that it's not something that we have that I disagree with. I'm trying to remember the episode we did where we were talking about. Well, I was talking about how I'm looking at listed investment companies because I think passive investment vehicles like ETFs have outperformed for the last 10 years, and I think their performance will revert to the mean and active management will outperform.
Yep. I think that was within the last month or so you were discussing that.
Yeah. So in the broader sense, I do agree that passive investment has had a massive bull run, and we see it in the massive valuations in the top end of markets. The top 100 companies, in the NASDAQ market, the top 10 companies compared to the rest of the market. A lot of that can be attributed to the ETFs buying and holding. But there's always a but.
Yes.
I think his example of Japan is probably a bit misleading.
Okay.
Because if you were only going to buy and hold American ETFs, the S&P 500 and the NASDAQ 100, then yeah, sure, you're probably you may hold it for 20 years and you may not get a lot of return, and if the market collapses around us and it takes a while to recover, you might not get made whole for a while. But that isn't the investment strategy that you should be pursuing. You shouldn't just be isolating your investments to one country, because if you were a buy and hold investor in the 90s and you did buy the Japanese index, you should have also bought other indexes, perhaps the NASDAQ in America, which had a massive bull run in the 90s, or the S&P, which did quite well in part of the 90s, and then in the latter half of the 2000s before the GFC, and then again after the GFC. You probably could have bought Australia, and on the back of our minerals boom, had a very good run from the 90s onwards. You could have bought, you get my point.
Yeah, absolutely.
The concept of buying and holding only works if you diversify your sources of risk, and across different markets and across different industries and stuff like that. Because like if you bought and held newspaper companies from the 1950s onwards, well, you would have had great performance in the first half of that, and then the terrible performance in the second half of that. If you bought and held, I'm trying to think of another industry that's going out of business.
Auto cars.
Maybe not. Maybe if you bought and held oil companies from today onwards, maybe you wouldn't get a lot of return, for the next 20 years, 30 years, 40 years as alternative fuels take over. Like, you can't just buy and hold one thing and expect to get 8% return a year. But the fundamental premise of buying and holding is a little more thought through than just it's done really well since the GFC. It's more that the index will rebalance over time, and the best performing companies will be added to that index as they grow, and the worst performing companies will be taken out of that index as they fall. And therefore, you will always have exposure to companies that will have grown and hopefully will continue to grow into the future, while you lessen your exposure to companies that are in decline. So a classic example of that is if you held the S&P 500 ETF, your exposure to companies like Facebook, Netflix, and Amazon has grown as they grow and become bigger parts of the index, while at the same time your exposure to companies like GE has fallen as they lose market share and they lose market value and they become a smaller part of the index. So obviously there's a little bit of, if a company's in the index, it's already grown a lot to get in the index. But as we've seen from a myriad of companies recently, they still have a lot of growth left once they form part of the index. And then also, buying and holding is very tax efficient and stuff as well. But we don't need to worry so much about that. So yeah, look, in the most general sense, I don't disagree that passive has done very well, and their performance will revert to the mean in some sense, and you'll probably see active management have a little bit better as investors, active managers look for value and find value, and the market realizes they're undervalued and some of the bigger companies might be a little bit overvalued. No doubt that will probably come at some point. But in terms of a strategy, I don't think that ETFs are going to be a passing fad in the same way that tech stocks in 2000 that had no revenue were. Yeah.
No, agree.
So that's my big rant.
Nice.
Do you have any thoughts?
I mean, it's pretty well in line with what I thought you would say, particularly around the, sources of risk, because we always sort of framed this concept of buying and holding and ETF passive investment with, it's a good strategy if you're still diversifying your risk. So I think you're right when you say that his example of just specifically Japan can probably be a bit misleading. But I guess my question is, do you think that means from his point of view that specifically for certain markets, he sees that over the next 20 years, he sees that there's going to be markets that don't recover to this point. He mentioned that we're in a speculative bubble at the moment, and he obviously has the opinion that when it does crash, it might not recover for an extended period of time. Would you take out that same sort of idea from him?
I don't know. I wouldn't want to put words in his mouth. I guess probably the other important thing is the back testing on buying and holding strategies has been longer than the last decade. Like a lot of back testing goes back to sort of the 60s. And
do you just want to explain what back testing is for our beginner listeners?
Yeah. So when especially like quantitative investors, so investors that use computer models to invest, they can back test their algorithms or their investing theories on historic market data. And so a lot of these quantitative investors will apply whatever their algorithm is to market data from like the 1960s onwards to back test their theory and see how it will have performed over time, because obviously you can't forward test and or if
crystal ball it.
Yeah, if you're testing it on live market data, you could do it as like a dummy exercise, but then you're beholden to the time. Whereas if you back test, you can calculate it quite quickly. So yeah, it's a common way that people test their theories and their formulas and their strategies. And yeah, look, at the end of the day, the market, when you think about what the share market is, it's all of these pools of capital investing in concepts and, you know, talented people whose main motivation is to increase shareholder value, grow their companies, and return money to shareholders. Like that is what the concept of a publicly listed company is there for. And I think, you know, the ability to invest in those companies over a long period of time, where they retain their earnings and they invested at a high rate of return and they grow their markets over time. I think it's a pretty time-honored theory that has worked quite well. And obviously there will be periods of, you know, a lot of money going into it, so it becomes overvalued, and so then your future returns are lessened, and there will be periods where, you know, active management does really well, or particular sectors do really well, and so money flows into those sectors, and then broader market indexes will then do better over a period of time because they're undervalued at the moment. Yeah, of course.
Yeah.
But I think, I wouldn't throw the baby out with the bathwater, I think. Just because there's a lot of money in it at the moment, it doesn't mean you throw the whole theory out with it.
Yeah, nice
and
one.
If Jesse Felder wants to have a chat about this...
Yeah, come on the show.
Come on the show.
That would be epic. Anyway... No, it's good, Ren. I always enjoy listening to your opinions. So, you know, pretty much I thought you would say very similar things to what you have just said. So, good that you haven't lost your mind over the last busy week of moving houses and stuff. So
Yeah.
Well, Ren, let's leave it there. If you have anything else to add, take it away. Otherwise, always good to chat. And I hope that was... If anything, we've exposed our listeners to two worthwhile investing podcasts to listen to other than our own. So, yeah, head over and check out Jesse Felder and his blog. He's a very, very intelligent man and worth following.
Yeah, definitely.
Yeah, we'll chat next week, Ren.
Sounds good.
Hello, mates of Equity Mates. Or I guess that just makes you Equity Mates. Anyway, it's Bryce here. One of the most frequently asked questions we get is, where do we find information about all these stocks and where's a good place to start? Now, we could do a whole episode on this, and we often do touch on it, but the best place to start is by signing up to our Thought Starters weekly email. Each week, we send you some cool stuff that has caught our eye during the week, as well as some more detailed articles on stocks and invested relating content. We also include Basics 101. These are articles tailored specifically for beginners to really propel you on your way. We don't spam you. I mean, we hate spam. It's once a week, and there's enough stuff in there to occupy you for a full day of browsing at work. Now, Ren puts a lot of effort into finding quality articles for you guys, so if anything, just sign up so he feels the love. Head to equitymates.com and chuck in your email at the bottom of the page.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.